for August 16th, 2020. So Pavel found this blast from the past. He was sniffing through the swing trading course and came across this trade framing video. And what's nice to see is that how little things change. The only difference between the trade framing that we did in 2014 to what we're doing now in 2020 on this chart is two things. I guess three things. We don't have the baby dragon on here, so you'll notice that we have the thick blue line is the RL10, the RL30, RL90, and RL270. I was using candles instead of bars, and the PSAR was built. This was just using a default 20 and 20, and it was based off of price and not off of the RL10. I still much prefer the RL10. But you'll notice just how beautiful and powerful that dragon is, and the beautiful river, floodplain, and so forth. So that's about a 9-minute video that talks about trade framing in Caterpillar, and it talks through the RLCO framework and the RLFF framework, and it lays out the architecture of this trade. And you'll notice that the big blue circles in the usual way represent important RLFF moments. Here's one where the RL10 crosses the RL270, and that's the breakdown of this sideways price here. And then you get that maximum excursion down here to where the RL10 peaks. And even then, we were measuring the distance from the RL10, in this case from about 100 back to 110. And then when it reversed, and then you have the P1, notice the dragon completely outside of the river. We wouldn't be surprised with a supported spring crossing entry in here somewhere. And then playing it back to the previous RL270, and it pretty much does that. Then you get another RLCO moment when you have the P1, which is the 10 crossing the 30 outside the river. Then the RL10 comes back down, and it's testing these same lows, and the dragon rolls over in the usual way. The RL30 rolls over, the health of the trend. And it terminated there on, this was Caterpillar on September 22nd, 2014. And it was trading at $100. And what we noticed was 2 really harsh days of selling in a row that left it at this critical state where we have it closed right at a support level, which previously held and then gave a great rebound trade. And then it had this sharp sell-off that brought it exactly back to that same turning point. And we framed the trade in both directions using the standard trade framing. And I used a, 5 cents, or in this case, since it's over $100, it looks like about 25 cents above and 25 cents below the daily candle. And we treated this as an interesting moment, an interesting possible turning point. And so we framed 4 trades, or 4 price targets, I should say, that if it broke out of this and started moving back up, we'd get an entry around 102.40. And we'd be playing for like a PSAR flip or middle of the dragon resistance. Resistance at the Bollinger Band mean and the RL90 confluence here at about 106.5. The peak of the dragon, which coincided with the river, at about 108.40, and then if it were to break above the peak of the PSAR and connect back to this support level here and get all the way from Z1 to Z2, that'd be about 110. So that's about a 10% potential move to the upside. And then because we framed the trade in the other direction as well, we said if it did violate below 100.40, then we would be doing a double position south, because this would have rejected all of the bounce, and whatever was causing it to sell would have been amazing. So that video, which takes about 9 minutes to work your way through the entire framework, it probably took me 6 minutes to rehearse it now, is definitely worth listening to. I got 9 thumbs up on it and 1,300 views in the time since then. Now, it just so I said, I wonder whatever happened on that trade. So because we can ask, we can find out. So here is the there's the doggies saw a raccoon outside. So that's where it happened right there. And so it broke down below 100, and that thing came all the way down. Instead of gaining $10 to 110, it lost $10 down to 90, and then set up a perfectly beautiful supported spring crossing in the usual way. You can imagine that being the action, and it came all the way back to, you guessed it, all the way up to the P1 moment, and beginning to cross the dragon again. And you can just feel this, I hope. The power of swing trading and getting those big moves right. So if you look at those bends in the dragon, and you get used to finding those critical states, and you go through the framing process of trading the frame in both directions, you will have visualized what it can reasonably do in either direction. And because it can reasonably do it, you don't have to know the specific reason why. All you have to know is looking for the evidence of price behavior in a certain direction. In the usual way. Beautiful swings in Caterpillar, making $10 and $15 moves on those big long swings. So Caterpillar is one of those frog champions that just trade beautifully. And so now we're up into 2016. These great big long beautiful swings that correspond with the business cycle. C3 breakout. So this is when it went from 90 to 175. So it doubled in that period of time. Doubled. And now here in the present, we're at 140. So it's been trading between 85 and 145 the entire period of time. So if you had bought it long back then at 100, and it's at 130 right now, after 6 years, it's made 30%, which is annualized. It's something probably 8%. But the opportunities to trade this rascal on swings is self-evident. So I posted the link to that video in Patreon just as a reminder of the blast from the past and why it's worthwhile to look at the swing time frames as being the real inventory management approach to portfolio management. That when you find items on the shelf or in your sales catalog that are exceptionally cheap or exceptionally expensive, after big sell-offs or after big buying frenzies, that being able to identify those big turning points becomes really crucial. So we've seen that already just in the microcosm of Caterpillar, just in the last month or so, where we identified in this box, we had identified a critical turning point that it had found support, exploded up here to a Z3, sold off to a 10-day low, and then had 3 days in a row it seemed to be holding. So if it's going to hold here, it might just go back and revisit prices at 141. And so we laid that out in terms of risk and reward, and we looked at the first two green boxes as the easier money, if there's such a thing, the third blue box as the decisive one, and then 4 and 5. So we saw potential for 5 units of reward just to get back to the top of this 10-day trading range. And a couple of days later it did that, even broached, and now we've got an excursion beyond Z2 up here into the atmosphere where the air is very thin. And then we had 5 days, 4 days of sell-off, almost a 5 DD, but 5 days of sell-off. So we framed this as a critical state going into Monday. So this is one that's definitely worth our attention. And Caterpillar, this is an example of the kinds of stocks and ETFs, the targets that we want inside our herd. Our herd is a selection from the global herd. Like, you can't track them all. This isn't Pokemon. So we get 40 or 50 of these sample symbols that are liquid, bidirectional, have long, smooth swing trades, and have enough volatility intraday to support turbo trading. And then by managing the herd and sampling from different segments of the total world portfolio, we can have variety in the symbols that we're tracking. Some are at the bottom of their wave, some are at the top, some are in the middle. So we have different elements of the business cycle. It might be energy up and finance down right now. It could be technology down and basic materials up. And going through this sector cycling causes these symbols to cycle. And in that way, we can find the sweet spot for our personal preference of patterns. What kind of things do we like to look for? I like to look for those P1s and the supported spring crossing and the harsh winters, because for me, that's the one that's the most interesting, because I can see where the previous high was and I can feel where people want to get that price back to, and I can frame that in terms of reward and risk with statistics. But I also know that when it's sold off, that there may be some deeper fundamental and technical reason why it could fail, some psychological reasons. And so if it fails further, then that leads into collapsing dragons. So that's kind of the position that we're in right here with Caterpillar, if I can just continue this this trade frame. So it tried this breakout, and then it has, for the last 3 days, written the 4 days if you count the day of the breakout where it failed, it's come back into the upper region of that previous trading frame. So if I were just to borrow this little box, so we're right back inside that previous trading range. And so now we should not be surprised to see that thing come all the way back down here and test 130. So what's that leave us? It leaves us 4 or 5 risk boxes all the way down. And look how nicely the dragon marks off those steps. So we're at the skin of the dragon, spine of the dragon, southern skin of the dragon, plus the Bollinger Band mean. A move to 135 would be the least surprising move of all. 135 is the Bollinger Band mean. That's the mean that price will revert to. So that would be the least surprising. In fact, even if it pulled back to 135, the river would still have an upward slope. This would still be very consistent with this move that's gone from 120 to 140. This would a move to 135 that found support and then continued higher would be perfectly consistent with the kind of price behavior that you see in the previous 90 days. So that's a non-surprising move. Does there have to be a specific reason that it does that? Or does the fact that it could do that satisfy? Yeah, it satisfies me. That would be the least surprising move. In fact, it made that move the last time it was at this price level. It sold off to the Bollinger Band mean and held. That time it came to 130. So if it just came to the Bollinger Band mean and held, like it did here, like it did here, like it did here, like it did here, the last 7 times it sold off, it held at the Bollinger Band mean. So if price does come to 135, no matter what else you say about that, you're not allowed to be surprised if it makes the least surprising move. So that's a move from 140 to 135. So that's $5. So if I can manage something like $1.50 of intraday risk on this, and I certainly can, because that's about 1%, then the intraday turbo move, that if it broke down below Friday's low, which is about 138.72, and then the high of the day is about 141.30, that's $1.50. So if I'm just using the range risk, I've got 1, 2 units of risk, or units of reward to 1 unit of risk, and getting to the PSAR would not be unusual because it got there the last time. So there's a $5 move is reasonably available. And then the move to the upside, well, we've already seen it at 145, so there's your $5 move to the upside. And it ended on Friday in a small range with a doji. That is the perfect definition of a critical state. So that is one reason why we can favor Caterpillar as a trading vehicle. You could trade this strictly with end of day data. You could put those buy and sell orders in right now and just trigger on them when price moves out of there. Or you could put those as alerts and have Caterpillar on your short list of intraday turbo trades. And when the alert fires, trade it with intraday size with a tighter stop than $1.50. And then if it moves sharply in either direction, you could then use the turbo money to fund the overnight risk of what will be a pretty good swing trade. So that's been the strategy for Caterpillar for the last 6 years. No change now. So I want you to recognize the thick red lines here as marking off the absolute normal case, the standard, which is the Bollinger Band mean. That's the least surprising price. And the edge of abnormal, which is the 3 standard deviation. That's why those are in thick red, so that they mark off the normal playing field for us from Z3 to Z3. It's a very rare event for things to break out of the Z3 boundary like they did here. Here was a Z3 breakout and it didn't hold, and what did it do? It came all the way back to the Bollinger Band mean in 6 days. And that was a move from 140 to 120. So $20 on 140 is 1/7, and that's 15%. That's a 15% move in 6 days in a stock that has only moved 30% in 6 years. But if you totaled up all the percentages of how the alligator crawled, then you would see this thing has a lot of potential as a swing trade in a great American company that everybody needs to own when it's favorable. And it receives buying pressure when the indexes are going up, and it gets selling pressure when the indices are going down in the broad market, because it's a member of those big indexes. and it's a member of the XL series. So when its sector, um, industrials, is moving up or down, it receives buying and selling pressure from there. So seeing that connection between market sector and company is also part of how you read the tea leaves. So that's the snapshot on Caterpillar, and thanks to Pavel for for that find. It reminded me of just why I love Caterpillar so much. And then you just notice over on the right hand side, there's a ton of goodies just on that YouTube channel, just waiting for you to review. Top 10 insights from the day trading workshop, thanks to Aruj, who's a anesthesiologist. The 2-hour battle drill from 5 years ago. I'm disappointed that it's only had 5,500 views. I would have thought it should be more than that. Exit rules and philosophies. That's one of Van's favorites of mine. The swing trading one day at a time. It's a crime that it only has 1.6 thousand views from 6 years ago. That is how you do it. So you should find that one. Swing trading one day at a time. And that's the same thing that I've just been talking through here. So that hasn't changed in 6 years. That thing is stable and good to go. And it is the central keystone, which is redundant. It's the keystone that holds up the bridge between long-term core positions and short-term day trading. Swing trading is that bridge between long-term and very short-term trading. And the keystone that holds up the bridge is this idea of swing trading one day at a time, along with the technique of framing the daily charts using the multi-time frame, multi-lens analysis. You see me looking at the regression line fractal framework. Here was a moment where the RL10 and the RL270 were identical. Here's the maximum divergence between the RL10 and the RL270. That's how strong the traders were pulling it apart. And this was exactly how far they were able to pull it apart here. So that's leg one. That was the critical state. Will it hold here and continue that way? Can't be surprised if it does that. But what if it fails here? Would we be surprised if it fails here that it falls another $10? That would also not be surprising. Both of those are equally plausible, equally defendable, and you don't even have to know why people are making those decisions. You can trust the fact that there's millions of people with computers and fundamental analyses making the decisions to move those markets around. You don't need to know why they're making those decisions, because sometimes that guy's right and sometimes he's wrong. And who's right or who's particularly wrong is not even as interesting as who has the most money and wins the fight. The guy who has the more money and has a directional bias wins. That's the way law of supply and demand. So that short-term momentum plays are the things that we're doing to take advantage of these surges that last 1, 3, 5, 10 days. And then it's like the train leaving the station and coming into the station exactly at the spot where it did last time. And what did it do in this big blue circle? It sold off $10. What did it do in that big blue circle? It sold off $10. So that's the standoff intermediate time frame lens that you need to have. It gives you the environmental context of what large money is doing to add to or reduce positions in these large cap stocks. This works better in the large cap stocks because what you're seeing is the risk management decisions that portfolio managers are doing to add to or reduce their various positions based on fundamental and technical analyses. Just further down that stack, pinch and stretch number one. The pinch and stretch series, which are in the base camp and in the hybrid frog trading and in the swing trading courses on the website there. That's 3 years old now. And it talks about the expansion and contraction of price as described by those moving regression lines. Very powerful. How we think about the extreme pinches and how we measure those on intraday versus swing trading positions. So all that's in the hybrid course and the swing trading course for you. That's fundamental. Pinch and stretch 2, which talks about the doggone chain trading. There's some more pinch and stretch for you. That leads to tactical chain trading intraday. The idea of hybrid frogs right from the open, using day trading or swing trading one day at a time. And then coming down to where you get the owl, and you'll notice that's where the supported spring crossing is going to be, and then leg 1, 2, and 3, or a pocket trade that leads to a collapsing dragon where you get leg 2. If this is leg 1 down, that's leg 2 and leg 3, until they form a sideways quiet channel and then a Z3 pinch, which is where you start playing the breakouts. So I've been talking about these things for 3 years. There's our various sniper exits on the regression line crossing the dragon. And talking about different reasons about how soon or how early or how late do you take entries and exits when you're looking at price with respect to the dragon. So once you internalize these lenses and you put them into practice and then refine your practice, you are internalizing the patterns that you can see in the world. Systems thinking, and how to look at our different processes from an input, process, and output perspective. 4 years old, and only 1,300 views. It's criminal. They're in the public view, so all I can do is make them available to you. What's funny to me is I get 2,000 subscribers, but only 1,300 views. I guess, all I can do is put them out there, lead the horse to water. So these are all videos that are available there in the hybrid trading course and on the swing trading course for the in the legacy course on Basecamp. And all the Patreon subscribers have access to that. If you're silver or higher, you have access to all those videos. And I'm happy to talk to questions that arise out of them. It gives me something to talk about during coffee talk. So I talked through Caterpillar. Let's see what we have. We have 3. Oh, Joe asked me to take a quick look at the daily report, the tactical summaries. Which part or two are drawing our attention? I look at every column, every row on there, Joe, and when you hear me going through the daily reports, you should be noticing the things that get my attention are the lights that shine. So if there's green dots in there where the different swing patterns fire, then I notice those. I look at the number of dojis. I'm looking at the RSI2. So I'm looking for any red or green lights, because those mark out the extreme conditions, either positive or negative, for any of those indicators and all of those indicators. The swing trades always get my attention because those are mechanical patterns that have been sort of validated and proved as being reasonable ways to trade, reasonable patterns to trade. It gives us a technical edge. So anytime those things fire, I go look at them. And then the other things are strategies where I'm taking a look at exceptional breakouts or breakdowns. I'm looking for the red and green lights that show me there's been an abnormal behavior in those symbols. In the same way that when you see me going through the weekend report, I'm taking a look at the extreme performers of good and bad, and as a way to try to find the symbols that are most in play, the ones that are most likely to make bigger moves in shorter periods of time in either direction. In the same way that Caterpillar jumped out as a way to be prepared. In fact, if I go back into the archives and take a look at the market health check on September 22nd, we would see why Caterpillar jumped out. I haven't done that, but maybe I should do it just to see if I'm talking smack. It'd be nice if it went back this far. So there it is, the daily report for 2014-09-22. Here it is. Tortoise Daily Report for September 22nd, 2014. The market was bullish normal. The chart's changed a little bit since then, but Caterpillar was the number one 10-day max pain. So there you are. Too funny. Ten-day max pain in Caterpillar. Looking at the Dow. So here I am looking at the Dow Tactical 30 for that day. Caterpillar it fired on the channeling and the overreaction, and it was a max pain, and it was the only member of the Dow that fired on the auto framer at better than 2-to-1. It had a 3.8-to-1 reward to risk ratio. The color code on the symbol was red, meaning it was a big percent loser for that day. And when I look over at the price change percentage, the fact that that cell is coded red means that it was one of the worst performers in the Dow that day, meaning that it was more than one standard deviation worse than the Dow 30 average. So the four symbols that were like that were Caterpillar, Nike, United Tech, and Disney. The five that outperformed, Merck, Coke, AT&T, Procter, and DuPont, were all more than one standard deviation above the Dow 30 average. So that's why their symbols are coded red. That's why the one-day price was coded red. Now, if I look at Caterpillar, I see that it has dramatically underperformed over the 1-day, 10-day, 1-month, 3-month. And the NDX is firing the red, meaning that it had broken down below the previous 10-day and 30-day range at the same time that Procter and AT&T had broken out to the upside. So all those red lights tell me that Caterpillar on that day was extraordinarily weak compared to the other members of the Dow. That makes it very interesting. You notice the RSI2 value at 3 was highlighted because it was in single digits. So you start adding all those things up, Caterpillar was the most interesting thing to go frame a trade on. So I went and framed that trade and recorded that video and talked about how it was in a critical state ready to make a $10 move in either direction, and then it did. It happened to go to the downside. So apparently, whatever the reasons were that were causing it to break down were good reasons. There was something deeper in there, it turns out. I didn't need to know why. I just needed to know it was a possibility. But I also knew that because of channeling an overreaction and this nice auto framer, that there was a very good reason to believe that people could be buying Caterpillar on sale. So when those buyers and sellers come in with their truckloads of money, it becomes a dogfight, a tug of war to see who's going to win, the buyers or the sellers. I don't care who wins. I just want to be on the winning team. It turns out that the Bears crushed it and took it down to 90. Okay, so I'll just follow them. And then when that stalls out, when they had their fill, that means everybody that was interested in buying it at 90 is now interested in buying it at 80. Even more so. It's even more on sale. So then it moves over the next 3 weeks from 80 back to 100, and so on for the next 6 years. So that's why Caterpillar is always on my short list for swing trading and day trading. It has plenty of volatility and plenty of volume, and it makes long, powerful swings. That's why it's a frog champion. So those are the things that I look at, Joe. I look at every single column, every single indicator, and the ones that grab my attention are the flashing lights. I'm like a raccoon. I'm a mammal. I'm attracted to flashing lights. Those are signals that represent significant performance differences between itself and the other members of that population. So that was September 22nd. If I wanted to call up the market health check to see what the larger market looked like, I hope it's in there. That'd be nice. I go to market MKT 2014-09-22. There it is. That's what the market health check looked like on that given day. So on that day, we saw that Caterpillar had already sold off sharply and was near its 10-day low. Well, this is a case where the S&P had been steeply up to 202 and then had sold off sharply for 2 days. So it was at a critical state that its breakout couldn't really last. So there was every reason to believe it could come down to 197. And what ended up happening was more weakness in the S&P, and that weakness in the S&P contributed to the further weakness in Caterpillar. So the combination of market weakness plus Caterpillar weakness leads to an irresistible move downward in the shorter period of time. And you notice that I did I was marking up green, yellow, and red about where my biases are for going long or short. Maybe I'll go back and do that again. It looks pretty good. But now you can see the connection between market conditions and the individual targets and how that stuff starts reading. So if you come down and take a look at the MACD histogram, at that time I was using PPO, which is a MACD but based on percentages. You can see that was rolling over into the fall. So there was more reasons to believe that this could fall further, and if memory serves, it did. Yeah, so I'm just flashing through a couple. Yeah, so the next 3 days in the S&P featured some massive sell-offs, and so now I am tracking with that next big blue circle the next place where it could test. Oh, and so that $10 or $15 sell-off in Caterpillar was happening at a time when the market itself was getting crushed. it had just gone from 202 to 192. So that's a 5% sell off in 6 or 7 days. So when you're trading those large caps and you're investing, now imagine you were trying to figure out the fundamental analysis of Caterpillar on a long-term business cycle basis. And so you use the, studying the financial reports and news and all that other stuff and trying to figure out what their prospects for earning money is going to be like. And so you develop a 3 months, 6 months, 12-month, 3-year forecast of where the fair price is. Meanwhile, these tornado and hurricane winds are blowing through the environment, pushing price around 10, 20, 30% at a time based on sympathetic vibrations of the market, the sector, and the company. The psychological response to risk, which is the fiduciary responsibility of the people that are managing portfolios. They've got to take that kind of dramatic action, and their actions are moving these prices around. And so you can spend all the time you want on fundamental analysis, but if you are a shorter term trader, I consider it a waste of time, because more of the short term volatility is coming from technical reasons and risk management decisions and portfolio readjustment and allocation decisions now more than ever. 2/3 of the money being pushed around intraday is being done by algorithms that are keyed to risk reward profiles of the algorithmic traders of big portfolios and hedge funds and mutual funds. So the fundamental analysis, can you believe anything that those guys are saying or writing? No, they are writing things that give them maximum plausible deniability while they still try to simultaneously play the game of insider trading. So to me, if you are on the shorter end of the time frames, understanding the technicals and looking at statistics to help you differentiate between normal and abnormal market conditions is absolutely essential. And just from a practical perspective, I just want you to notice why naming files correctly supports all of this. So this is the only way that I name my market health checks: MKT, year, month, and date. So when I dump them all into one giant folder, they just sort alphabetically and chronologically the same way. And the daily reports, there's 5 years of daily reports starting from 2013 December 17th up until Friday. So I can go back and pull up my index cards and file snapshots and all that in my trading journal to see what's going on. So I can go back and test other ideas and trade forward if I need to. And it all comes from just having an infrastructure support a file naming protocol that allows me to recall all that stuff. All right. Let's go take a look at some trade frames then. How cute is this one? All right, so here's Verizon, and I like what we got right here. Come on, snip. So what we've got is, there you go. All right, we have I like that we've got the this yellow box showing a reasonable recent trading range between a peak of the RL. Notice how the RL10 has rolled up and is almost rolling over here because of this downward pressure. That RL10 is rolling over. So that forms the upper portion of this box, which was also that gray zone's the peak of that that daily frame. So if it does get above 59, come on. Come on, ink. Giving me a hard time here. Sorry, I'm locking up. Let's try this again. There we go. All right, so we've got why is that pen working for me here? Shit. All right. Well, we have that pen's not working. So, I know what that is. The breakout box is in the gray, so it's playing a breakout from the high of the day at 59 and looking probably to add a position at Z1 and I'm sorry, at Z2 and Z3. This orange line is looking like, I don't know what that is. Not clear to me what that orange line is, so I'm going to ignore it. And then the breakdown from the PSAR, I like the short at the PSAR because we've had this big red candle was like an extreme and then sell off. And even though there was some buying pressure, it kept losing prices. So if this one-day resurgence here from Friday fails, then the PSAR will have broken. And then you could see price coming back to 56 to the Bollinger Band mean. I'm not sure what the yellow dashes are. Not clear to me. So I would be playing short from 58.50 coming to 56.50, so that's $2. So if you had about a 50-cent intraday risk, which would be the size of one of these daily bars, that's certainly frameable in both directions. And I believe if we looked at the daily report, we would see that Verizon was one of the max. I think it was a max pain. All right, let's take a look at. Let's take a look at Devon Energy. See if ink is going to work now. Okay, so this is the opposite of directional moves. What we really have here is um, we've had this massive move down following the dragon. We found the PSAR flip, so the belly of the dragon has been acting as solid support. The PSAR has been acting as solid support. I don't think your PSAR is correct. Unless this is on hourly. Oh, this must be hourly chart. Oh, yeah, duh. Hourly charts. No, 30. Oh, sorry, 30-minute charts. Silly me. So this is actually great news. On Friday, it held support tightly in this range, and they were willing to hold that price level over the weekend. So I think I would be ready to get long here, just as you are. Price breaking out of that box, and adding a position if it breaks above the RL270, I think is reasonable. I think this is probably a target. I'd like to have two positions in, so one here and now two from here, and then I would want to see this thing really get through before. I think I would want to get above here. This is where I would put the third position in, because this is the one that is most likely to fail right here. Like everybody that bought back in here and has suffered all the way down here. Well, if they were still holding on and they were able to get all the way back up here, this is where they might actually say, enough is enough. And then that's where it failed big last time. So I think I would like to have two positions in, one here at about 1240 and one at 1210, and have both of those heading north. And then if it broke here, then it's either going to fail and then I cash two, or if it gets above this line is where I think that's where you add the third one. So Devon Energy, nice company, but this move from 12, or no, I'm sorry, from 13 to 11 and a half, from 13 to 11.5 is 1.5, and that's a 10% move. And it's already moved back this much, 12 to 13. So that's still an 8% move up to here. Yeah, I like that one a lot. On the short side, I don't mind that at all, because now what you'd have would be a big sell-off, short rebound, and then collapse. But this one, we're going to want to watch XLE and USO and see what they're doing to see if that's going to add juice this way or that way. Now, Devon Energy has had better, Devon Energy DVN has been better than XLE. So there has been some buying pressure on Devon Energy. So it wouldn't surprise me if, even if XLE was doing okay, but Devon Energy was doing great, that would be a really good sign. So I like Devon Energy here. It's a good trade frame. Tradable in both directions. Next one up is Cisco. This is kind of a special case. This is the daily chart. And Cisco, we saw from the weekend report, had just gotten assassinated from earnings. And so when you see that much of a sell-off, you just know that the rest of this really doesn't matter that much, although you know that it can go from here to here in a kind of orderly fashion, and that's from this price level here. And the size of this sell-off enabled it to go to here. So yeah, a move back to 48 is not irrational. The fact that it held here 2 days in a row is kind of useful, right at fair value, the RL 270. And this is almost where, if we went back far enough, we'd see, pardon my lack of straight line. So there's clearly a reason to be short this with targets here and here. And I like that you've identified where you want to get your other positions in. So 38 and 40 are both in range from 42. So that's $2 and that's $2. So if I can manage something like a 50-cent initial risk, that's 1.2% as an I stop. And there's your 1, 2 scoops on the way down, and then you could see 1, 2, 3, 4 climbing back up the stack. So there's 4 to 1 to the upside, 2 to 1 to the downside, and a strong indicator of support here, and then a support here. This price at 44 looks really important because this is just a tactical move to 44, and that's why I would be intraday only. So that's a $2 move, and you might make some money inside there and use that to fund the overnight risk. But it could very easily get to here and then fail again. We don't really know anything about longer term intentions until it starts filling in this gap. And so to do that, it has to get past 44. So we can trade it out of this yellow box to 44 on a single position, and then get a second position with markets money once it gets above. And then on the short side, that's just a no-brainer. So we would be looking for XLK and the Qs as the market segments to see, are they going up or down, and then what's Cisco doing as part of that. Okay, so good trade frame. I like it. All three of these are things that can be traded intraday because they have lots of volatility, lots of volume, and they are in critical states. Okay. Let's see. Joe asked, the strength of trend on the RL30 shows up in the Z-score. No, not really. To me, what you're looking for, what you want to look for is the, I'm going to talk about the slope statistic here. Let me get my little sketch pad on here. So there's some flashcards in the hybrid workshop that talk about slope statistics. So I'll just be brief on this one. So blue is RL10. That's the price, the smooth price. The black line is the RL30, and that is the health of trend. So you want to look at the slope on that one. The RL90 is the health of the trend of next higher time. It's also the price of 2 times higher, in the same way that the RL30, the health of the trend, is also the price 1 times higher. The RL270 is the price 3 times higher. That's where that fractal nature comes in. So the RL270 is long-term fair value. Because remember, this stuff, the RL10 times 3 gets you to the RL90, and the RL, or to RL30. Then RL30 times 3 gets you to the RL90, and the RL90 times 3 gets you to the RL270. So in this pair, the RL10 and the RL30, that gives you the price and the health of the trend, because the RL10 is fast and the RL30 is slow. The next pair, the RL30 and the RL90, have the same relationship, it's 3 times more, as the 10 and 30, except it's just 1 time frame higher, so it's times 3. So whereas on my charts, the RL30 shows the health of the trend, when I look at it, I'm also seeing the price of the next higher time frame. And when I'm looking at the RL90 on my chart, I'm looking at the health of the trend of the next higher time frame. In other words, but also what the price of it 2 times higher would be. So you get this very fractal relationship, and on one single chart, you can see all that stuff going on. Well, when I talk about the slope then of the RL30, what I'm really saying is that the RL10 could be 1 leg down, 2 legs down, 3 legs down, and then starts to turn up. And during that whole period of time, while the RL30 is or RL10 is wobbling around, you get this very smooth and orderly flow in the RL30 that looks like that. That's what makes these turning points so important. The price would have done something like that. So that makes these turning points really important. Because that smooth RL30 is helping you mark off those key turning points. Now, it doesn't surprise us when those turning points actually hold, that where that RL10 turned, that's where the PSAR, when the PSAR was marking its way down, and then it flipped, that's where that PSAR flip occurs, and then the PSAR starts moving up. So this whole turning point in here, and this turning point here, matters a lot. And the actual little wobbling of the price in the RL10 is not as important as these big turning points in the RL30. That's why in the owl pattern, the 5th criteria is the slope of the RL30 reverses back up. So you could look at these major turning points and then this long, slow slide, and you just break that off into like 3 segments. Here's a transitional state, here's a transitional state, and here's that trending state. That's like the second leg. When the RL10 is in the second leg, then it's smooth and the RL30 is smooth. That fat piece in the middle is the piece that we're locking in. That's the 1/3 in the middle. That's the feels like easiest money. So basically, when we're seeing that price roll over, and we get those collapsing dragons in here, we had enough indication that it was going down, and we really hope to see a full move in here, and then try to keep as much of this as we can before it makes its turn. So we're trying to get this segment out of the middle. We're trying to get our entry earlier and our exits later to expand the size of this middle piece, this fat middle piece that we're getting out of the middle. All right. And the clearest indication of what's going on in there is the slope. The health of that trend is the RL30. The other thing to remember is that when I had that, when I have the river, and I have that Bollinger Band mean inside the middle of the river, that's an SMA 30. And when there was a really harsh winter, that reversed, crossed the baby dragon, then that RL30 became spring. And spring, the RL10 crossed that dragon. So you get the RL10 here. The RL30 was also flowing down. Hey, there's your P1. And then the RL30, that slope changed right here. And that's the marker that tells you now we're in owl territory. Because the fifth criteria of the owl was that the slope of the RL30 had to be going up. The fourth criteria was that the slope of the dragon had to be down and then start to curl up. The third criteria of the owl was the RLXD. So this is what gets us to the supported spring crossing, is that we're actually taking that third criteria of the owl. And we're getting an earlier entry, and quite often that thing works. If you're trading the owl pattern, which works really nice on swing trades, especially when you've had a big sell-off, like Cisco, waiting for the owl is fine because it's slower to turn. There was a moment in this move on the downside when the RL30, which had been north of the Bollinger Band mean, got south of and so during this whole move down, the RL30 slope was negative, and then this thing will improve, and the RL30 will come back in, it'll enter the river, and it'll cross the SMA 30, and then when it crosses the river, now you had price, and the RL10 has left the river, and then when the RL30 leaves the river, you now have price, the 10 and the 30, all north of the river and all traveling up together. That is the beginning of trending behavior. So while we spend a lot of time talking about the tactics of this turning point and how to handle all this stuff, really when you step back and look at it, when the RL30 crosses the SMA and then gets to its peak or minimum down here, and then reverses and comes back to cross and reconnect with the Bollinger Band mean. That's your turning point. And then as soon as it leaves the river, that's the beginning of trending behavior to the upside. So this is all tactical trading inside this triangle formed by when it crossed the SMA. That's the RL30 crossing the SMA 30. So they're both using 30 period lookbacks, but that's the difference between the regression line, which is quicker to adapt, and the slow, simple moving average. You'll see this time and again. Once you start looking at that lens, you will start seeing these turning points. You'll see it when it crosses the Bollinger Band mean. And you'll see when the RL30 rolls down and reverses up. And you'll see it when it enters the river, crosses the river, and leaves the river. And you'll learn to read those as very significant turning points and checkpoints in this cross-country traveling trip that we're doing. Okay, so that's what I want to say about the RL30. The RL30, his slope, the slope of the RL30 is the health of the trend. It tells you whether it's weakening because it's failing, it's slowly improving, so it's got the possibility, and then it's confirmed that it's healthy when it leaves the river and is going up. So the RL30, the most important thing on that is as an indicator of the health of the trend. That's the slow. Your health is slow to change. Your feelings is the price. That is quick to change. So RL10 is price. RL30 is health of the trend. RL90 is the health of the next higher trend. And the RL270 is the long-term fair value. So seen through this same lens, there's some moment when the RL10 and the RL270 are together. That means the short-term trader's price and the RL270 long-term fair value both agree that this current price is correct. And then the traders take it in some direction, maybe south, which I prefer. Then the RL10 follows that very quickly to the point where it can't get any further and starts to curl up. In the time that it takes to do that, the RL270 won't change much. And now what we're measuring is the distance. That pull is like a big bow and arrow. How far were they able to take it this way? And that's how far it's going to return. So that acts like a reversion to the mean, in this case, reversion back to the RL270. What makes that even more powerful is if the VWAP was in here too. When the VWAP and the RL270 are at the same, that's where price is going to go. Once it gets as far as it can, it's going to come back to here. Mathematically, it will. And then inside the tactics of that, you'll see that RL30 comes down here a ways. And that is a much smoother measure of the health of the trend than the RL10, which can wiggle and wobble and all that stuff. So again, when you see these departures here, gets to the peak RL30 and then back, those become important checkpoints in this little theory of price description and interpretation. Okay, so that's what I want to say about that. We're an hour and 20 minutes into it, a 10-minute explanation. And that's everything I wanted to cover. That covers all the charts that were posted. So that's everything I got for you tonight. Okay.